Hi, and welcome to 2023. I trust everyone had a wonderful holiday season. Whether you reached your personal goals from last year or faced challenges with 2023, a new year has begun. We'd like to jump right in and talk about our first very important topic of 2023, which is deemed Secure Act 2.0. This was following Secure Act 1, which came into law in late 2019. In 2019, it raised the requirement from age 70 and a half up to 72 for required minimum distributions and increased access to retirement accounts. But it didn't take Congress long to say, well, we need some more improvements. So, inside this 4,155 page, $1.7 trillion spending bill, there's plenty of goodies, including another overhaul of the retirement laws. Again, deemed Secure Act 2.0, the bill enjoys widespread bipartisan support and builds on Secure Act 1 by strengthening the financial safety net by encouraging Americans to save for retirement. We're going to hit about 9 key takeaways, which is just an overview, but at least it'll give you an idea of where this new Secure Act 2 fits into your planning. The first thing, as I mentioned, was we changed the required minimum distribution back in 2019 from 70 and a half to 72. Now, this year, if you turn 72, the age required for required minimum distributions has changed to 73. Now, if you turn 72 in 2022, you still have to take your required minimum distribution based on the prior schedule. But if you turn 72 in 2023, hypothetically, you could delay required minimum distribution until 2024 when you turn 73, or you could even push back that very first RMD up to April 1st of 2025. But remember, you'll then have to take 2 RMDs in the year of 2025. Starting in the year 2033, the age for RMDs will rise to 75. So for all you younger listeners, you've got a little bit more time to save. Employees enrolled in a Roth 401k won't be required to take RMDs from the Roth 401k beginning in 2024. That's welcome relief. You don't have to take distributions from a Roth IRA, so having to take distributions from a Roth 401k, we need to get that in line. In our view, Secure Act 1 and Secure Act 2, this was long overdue. The new rules recognize that Americans are living longer and working longer. One of the largest penalties, in fact, the largest penalty I'm aware of, was if you did not take a required minimum distribution. It was a 50% penalty of the amount that you failed to take plus taxation. Well, with Secure Act 2.0, that's going from 50% down to 25%. And as long as you, in a timely manner, try and correct the mistake, the IRA holder can file an updated tax return and hopefully have that reduced down to a 10%. But remember, it's still a penalty. So take those RMDs on time. Now, there was a shot in the arm for employer-sponsored plans. Too many Americans don't have access to an employer plan or simply don't participate. Starting in 2025, companies that set up new 401ks or 403b plans will be required to automatically enroll employees at a rate between 3% and 10% of their salary. The new legislation also allows for automatic portability. That means you could take a small balance if you worked for one employer and move it over into, transfer it into the retirement account of your new employer. Hopefully then people won't just cash out these small balances, normally paying taxes, and if they're below 59.5, paying a 10% penalty. So there's also some incentives. Employers could give you a gift card or a small cash payment. I guess you'd call that a signing bonus. But employees may opt out. But it is a way that we are encouraging more and more people to save for retirement. Another interesting part is the increased catch-up provisions. In 2025, Secure Act 2.0 increases the catch-up provision for those between 60 and 63 from $7,500 in this year, 2023, if 50 or older, to $10,000, the greater of $10,000, or 50% more than the regular catch-up amount. And that's going to be indexed for inflation, so that number will go up a bit. So that's really interesting. I don't know why just 60 through 63, but that's what passed in Secure Act 2.0. Charitable contributions starting in 2023 allows a one-time $50,000 distribution to charities through charitable gift annuities, charitable remainder unit trusts, and charitable remainder annuity trusts. You must be 70.5 or older to take advantage of this provision. The $50,000 limit counts toward the year's RMD. But remember, now RMDs really don't start, starting this year, until you are age 73. It also indexes an annual IRA charitable distribution limit of $100,000, known as a qualified charitable distribution, or QCD, beginning this year. Here's an interesting one, the backdoor student loan relief. Starting next year, employers are allowed to match student loan payments made by their employees. The employer's match must be directed into a retirement account, but is an added incentive to sock away funds for retirement. There's about 3 more that we want to mention. One is disaster relief. You may withdraw up to $22,000 penalty-free from an IRA or an employer-sponsored plan for a federally declared disaster. Withdrawals can be repaid to the retirement account. The next one is help for survivors. Victims of abuse may need funds for various reasons, including cash to extricate themselves from a difficult situation. Secure Act 2.0 allows a victim of domestic violence to withdraw the lesser of 50% of an account, or $10,000 penalty-free. This last one, rollover of 529 plans. Starting in 2024 and subject to annual Roth contribution limits, assets in a 529 plan can be rolled into a Roth IRA with a maximum lifetime limit of $35,000. The rollover must be in the same name as the plan's beneficiary. The 529 plan must be at least 15 years old, which means for those of you who started 529 plans for your children or your grandchildren some years in the past and the money never got out of the 529, we now have an option for you. So these are some of the things that we welcome as changes and revisions, because as we know, many Americans lack adequate savings. So the just enacted bill addresses some of these challenges as we move towards retirement. What we've provided here is just a high-level overview. Keep in mind that this is not all-inclusive. Know that we're always here to assist you, and we at Prosperity Partners Wealth Management hope we can answer your questions and tailor our advice to what are your specific concerns and needs. Additionally, make sure that you reach out to your tax preparer for any of the tax consequences that are related to in the Secure Act 2.0. Thank you for joining us, and make 2023 your best year ever.